S&P 500 Index SPX, long-term, chart analysis. In our previous analysis, we stated the S&P 500 Index, SPX, experienced a downturn last week, mainly driven by a sell-off on Thursday, culminating in a weekly loss of minus 1.37%. Current week analysis. Last week, we maintained a bullish stance, anticipating the impact of the upcoming presidential election. The potential for a Republican victory suggested significant market movements. Indeed, this outcome led to a notable 4.66% increase within a week. The Conservative S&P 500 strategy is crafted to shield investors from bear markets, allowing it to withstand short-term declines without triggering sell signals. This strategy is rooted in long-term chart analysis, avoiding decisions based on emotions or news events. It is designed to embrace market fluctuations without attempting to time every minor movement. We currently hold a bullish position in the Rydex S&P 500 Nova Fund, RYNVX, or comparable S&P 500 index funds or ETFs like SPY. S&P 500 Index, SPX, and current chart analysis. Last week, we observed the U.S. stock market is entering its historically strong months from December through April. Contrary to the adage sell in May and go away, stocks remained robust for several months. This week, the market strongly favored bulls, with small caps in the Russell 2000 Index, RUT, surging almost 9%. After a prolonged period of underperformance, small caps reached new all-time highs. They had been stagnant for nearly 3 years. In 2016, the stock market rallied following the Republican presidential victory, a trend that continued for almost 3 years. Could we witness a similar scenario? Notably, the S&P 500 Index, SPX, also rose by 4.66%, closing at new all-time highs, indicating a robust rally under the new administration. Although we did not expect a repeat of the 2016 rally, current market behavior mirrors it. With the Republican nominee's election, economists predict fewer Federal Reserve interest rate cuts than previously anticipated. Mark Spindle, Chief Investment Officer at Potomac River Capital, noted, Trump favors spending and borrowing, reflecting his background as a real estate developer. This fiscal approach, combined with existing high debt levels, suggests the Fed may lower expectations for future rate cuts. Despite this, the Fed reduced rates by minus 0.25% this week. The SPX has outperformed the S&P 500 Equal Weight Index by 8 percentage points this year, driven largely by its heavily weighted stocks. This is significant as the SPX has surpassed its equal weight counterpart by at least 5 percentage points only 6 times in the past 50 years, often leading to strong gains the following year. Market breadth, assessed via the NYSE Advanced Decline Daily Chart, reached its rising 50-day line, which successfully provided support. Current indicators suggest the potential for higher highs in the coming weeks, with breadth supporting the stock market's upward trajectory. As Donald Trump assumes the presidency, he faces challenges such as averting a potential World War III, managing an economy inclined to raise interest rates while promoting growth, introducing tariffs to safeguard American manufacturing without harming the economy, and securing national borders. Economic reports influencing the market this week. The 30-year mortgage rate, predominantly used by homebuyers, has increased sharply over the past 2 years as the Federal Reserve seeks to control inflation. U.S. stock benchmarks posted strong gains on Tuesday as investors awaited the election outcome, pondering another potential Trump presidency or a leadership under Kamala Harris. U.S. stocks rallied on Wednesday, with the Dow rising over 1,400 points and the S&P 500 and NASDAQ each climbing more than 2% following Trump's re-election. Investors are optimistic that a second Trump administration will stimulate economic growth, benefiting businesses through tax cuts, deregulation, and trade tariffs. The number of individuals filing for unemployment benefits in the U.S. increased by 3,000 to 221,000 in the last week of October, aligning with market expectations. Despite this slight rise, the count remains well below earlier monthly averages, indicating resilience in the U.S. labor market. The University of Michigan's Consumer Sentiment Index for the U.S. rose to 73 in November 2024, the highest in 7 months, compared to 70.5 in October and surpassing forecasts of 71. However, these figures do not account for reactions to the election results. Conclusion: the SPX strategy remains bullish. Aggressive traders should consider positions in the Rydex S&P 500 fund RYNVX or other bullish S&P 500 index funds or ETFs such as SPY.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.